So, Buffettology. So, Warren Buffett, does anyone know who Warren Buffett is? So, what do you know about Warren Buffett? Excellent. Yeah, investor, philanthropist. Those are great answers. Lives in the small house he has, billionaire. Yep. Yeah, good point. Cash says he eats McNuggets for breakfast, dinner, and lunch. How his brain works without IDK. Yeah, that's a good point. Uh, American business magnate, one of the richest men in the world. Yes, exactly. Yeah, all parts of who he is. So he's the best investor in history. Um, Owner of Berkshire Hathaway. Yeah, great points, everyone. So he's the best investor in history, and there's a lot of reasons why. So his company is the graph in the top here. So you see the big difference between the rest of other stock markets and other companies. This is how much more his company has made compared to the other companies in the market. So he's been that much more successful than everyone else. So his methods have really worked to generate a lot of return. So I'm going to post this in the chat. Yeah, his methods have been very successful. So he has a lot of quotes. This is one of them. So investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen, but if you got talent yourself and you've maximized your talent, you've got a tremendous asset that you can return tenfold. Warren Buffett. So as far as I'm concerned, the stock market doesn't exist. It is there only as a reference to see if anyone is offering to do anything foolish. So his whole thing is he buys a business. So his whole goal is he invests in a business, not a stock. So he looks at the business operations and determines if he should buy it. So that's really what he looks at. He doesn't invest in a stock, he invests in business. So he really so he values management. So like he wants to buy a business that has good operations. So that's really his focus when he invests. So as he said here, investing is often described as the process of laying out money now in the expectation of receiving more money in the future. At Berkshire, we take a more demanding approach, defining investing as a transfer to others of purchasing power now with the reasoned expectation of receiving more purchasing power after taxes have been paid on nominal gains in the future. So his four principles are that we need to invest in businesses we understand and run by people that we can trust. So that's very important, and also fair. We need a fair price. So his whole thing is we want to invest in what we understand. Uh, the managers need to be trusted. The business must be fairly valued. Buy businesses, not stocks. Only invest in what you know. And yeah, so that's very important. So all these things that he talks about here are very important in terms of the keys very important to what we should invest in. Yeah, so I'll post this in chat here. So yeah, if you start investing, the keys are doing all of those things. So I recommend go to how the market works and then research companies that would meet all of these guidelines. It's like only so like buy stocks on how the market works that meet all of these guidelines. So I recommended you to do that. You can do that now or after class. So that's why I'm going through this because I want you to test this out to try to invest with these guidelines. So understanding the influence of Ben Graham on Warren Buffett, the story of Mr. Market. So here the whole so I'll let you read this for a few minutes, and so I'll leave this up for about a minute, and then I'll bring up the next part, and then I'll ask you what it means. So I'll ask the class to read through this passage here, and then I'll click next on the next page so you can read through that passage and just tell me what you learned from this. So what I'll do is for people who haven't finished reading, I'll post this into the chat so you can review it while like I switch to the next page here. So yeah, here it is in the chat. If you still are reading, you can read it in the chat. And then here I'll keep this up for a while, and then I'll ask what you think this means. So I'll just put this in chat too. I'll just leave it up and keep it in the chat. So I'll ask you, what do you think this passage means? So what it means is only buy into a business. If a stock goes down one day and the business hasn't changed at all, then don't sell your stock. The stock can go up and down every day, but if the business is still good, then don't sell your stock. Yeah. So like stock prices change every day, but the business but the business may still be the same. So only check if the business changes. Don't care about stock price changes. So that's really what this is about here. That's really important. So good news, the market is dropping. So based on this, if the market is dropping, if stock prices are dropping and the business is the same, buy the stock. So like for example, if you have a great company that has amazing operations and the stock price goes down, the stock is cheaper and the business is still good. So you can buy it at a discount value. So that's a big opportunity for you. If the stock price goes down when the business is the same, then that's a good opportunity to buy. So that's really what Warren Buffett's strategy is, like finding where you can find cheap prices for stocks. So recognize that a majority of investors can play the short-term investment game. So most just sell when the stock price goes down. So most investors sell on panic. They don't monitor the quality of the business. So that's the problem. That's why a lot of people lose money in the stock market. People lose money in the stock market because they play the short-term investment game. People sell on bad news. So the whole thing is you just have to monitor and determine if the bad news will not affect the company's profit slash operations. If the bad news doesn't affect the company's profit slash operations, don't sell. So that's very important for investing. So yeah, that's a very important strategy to use because because it doesn't always affect the company's operations and profitability. So then companies have a franchise product and thus a competitive advantage, have the economic power to weather most bad news storms. So having a competitive advantage is very key. So if a company has a competitive advantage, they will probably succeed regardless. Always invest in companies with a long-term durable competitive advantage, which we call a franchise product. Product characterized by few or no substitutes, product in demand by many, little or no government regulation. So market volatility is your best friend. So like, let's say this is a good company. Let's say this is a good company, honest management, high profitability, high return on equity, cheap, low price to earnings, low price to sales. Let's say here and excellent operations. Let's say this company has all of that, then the price just goes down like this. Then the price drops substantially. Would it be a good idea to buy? So would it be a good idea to buy if it's good company's price just goes down like that? So it would, because so it would be a good idea. It would be a good idea because you can buy this good company at a cheap price. So it would be a good idea because you can buy this company at a cheap price. So that's a good opportunity for you to get a company at a cheaper price in this case. So I'll post this for everyone here. So here, the buy when a good company's share is low and sell when the price is a maximum. Yeah, that's exactly. Yeah, sheesh. Yeah, that's exactly it. So as she said, buy when a good company's share is low and sell when the price is at a maximum. So yeah, that's a good strategy. So if you follow that strategy, yeah, that's what Ashish said. That's a great point here. So that's exactly what you want to do here. That's great, Ashish. So the driving force of Warren Buffett's investment strategy is the rational allocation of capital. So determining how to allocate a company's earnings is the most important decision a manager will make. Rationality is the quality that Buffett most admires. So Buffett's success has been dependent on as much as eliminating those things he can get wrong, which are many, i.e., predicting markets, economies, and stock prices, as on getting things right, which are few and simple, valuing a business. There are two simple variables Buffett focuses on: the price of the business and the value of that business. So you ideally want, so you want the price of the business to be fair or discounted, and the value of the business to be higher or equal to the value. So you want the value of the business to be higher than the price of the business. So that's what you want, and that's exactly what you should be focus. Like you should focus on value and price here. That's very important. So Buffett's 4 steps to investing and how stocks will make you wealthy. So turn off the stock market. So remember that the stock market is manic depressive, wildly excited, sometimes unreasonably depressed. This behavior creates opportunities, but you do not allow the market to dictate your actions. Don't worry about the economy. Buy a business that has the opportunity to profit in any economy. Buy a business, not a stock. Change your perspective to that of a business owner and learn as much as possible about the business industry. So number 4, I disagree with. Manage a portfolio of businesses. Don't diversify for diversification's sake. I disagree with that because diversification is important to reduce risk. So like I think you need diversification. In this case, I disagree with his view on diversification. I think so for example, I invested in crypto last year, and the crypto market collapsed basically. So you want to own companies from different industries to prevent risk. So like owning, let's say like owning railroad companies, bank companies, tech companies, car companies, and others will prevent risk because you diversify across industries. If one industry goes down, you have other investments in other industries. So diversification is key. So I recommend diversification just to prevent risk. So yeah, diversification is really important here. So make sure that you diversify your investments. So chapter 2, concepts every investor should know. So interest rates. When interest rates rise, business becomes more difficult and vulnerable. This is due to the high cost of borrowing money to invest in the business. When interest rates decrease, it's easier to borrow capital and therefore expand capacity and activity. Hence, interest rates are the price of borrowing capital of the business. In Finance 101, you should have already covered the before and after tax costs of borrowing capital. Federal Reserve determines interest rates in 3 different ways, all of which you should be familiar with. So, recognize the enemy for inflation. So, inflation is not is an issue because the problem with inflation, inflation eats away at the value of your money. So if you make, let's say, $40,000 per year and inflation is 10% per year, next year your real income will go down to 36,000 because of inflation. So so based on this, the 72, so using the rule of 72 divided by 10 equals 7.2 years. After 7.2 years, your $40,000 salary will be worth $20,000 in real dollars. So inflation eats away at the value of your money. That is why we need raises. Because if we don't have raises, our income will become much less, over time. So common stock is a good inflation hedge. So if you invest in the S&P 500 index, these are your returns. So I'll show you where the returns are. So these are the returns. So you're getting between like 10 to 15%. And then the inflation is about 3 to 5% here. So right here, the inflation is 3 to 5%. So you are making enough to beat inflation investing in the S&P 500, which is great because you will not be losing your money's value through inflation. So that's important here. So I'll post it in the chat for everyone here. So financial statements. So in a financial statement, if you're going to look at the financial statement of a company, you want this to increase over time. So you want this number to increase over time. You want this number to increase over time. So those are very important. So, and then you want also this number to increase over time. So ideally, you want all of these 3 numbers to increase over time. So that's really what you want from that. That's what you need to for the investment to be a good investment in this case. So So that's key. So in this case, I'll ask you the question, which are like are all or any of these three numbers increasing from 2012 to 2014? So I'll ask the cost list. Are net revenue, net income, or earnings per share increasing or from 2012 to 2014? So does Abisha want to try this one? So Ashish said in 2013 EPS and net income slightly decreases compared to 2012. That's great. And then the net revenue increased. Yeah, good job, Ashish and Abisha. Excellent. That's great. So yeah, net revenue increased during this period, but net income went down. Earnings per common share did go up though. So we'll go through the balance sheet here. So the balance sheet, so you want on the balance sheet, you want cash and cash equivalents to go up here. So you want this to go up right here. And then you want this to go up here. Yeah, so that's very important. You want both those to go up here. Yeah, the net income saw a decrease in 2013 and then again increase in 2014. Yeah, that's true. That's true. Thanks, Abisha. So you want both, in this case, you want cash and cash equivalents to go up and you want total shareholders equity to go up. So I'll ask you, are cash and cash equivalents going up from 2012 to 2014? Are total stockholders equity going up from 2012 to 2014? So I'll ask Audrey, do you want to try? Yes, so cash and cash equivalents increased in 2013, but then decreased in 2014. Good point. Good point. And then going up from 2012 to 2013, but going down 2013 to 2014. Yeah. Yeah, good point there. Yeah, so we want cash and cash equivalents to go up. So that's an important thing that Warren Buffett looks for in a company. So that's something that you can look at when you're looking at the stocks you want to invest in. Yes. And then what about stockholders' equity? Wait, I think someone may have said that. Oh yeah, Baham said that. Great job, Baham. Great job, Abisha. Excellent. So stockholders' equity went up 2012 to 2013, went down 2013, 2014. Good job, everyone. That's great work. And then here, I'll show you the types of information that we got to look at here. So here, Current ratio is really important to look at. That's very important. Also, yeah, that's very important to look at. Also, debt to equity is very important. Net profit margin is really important to look at. ROE is very important, and price to earnings ratio is very important. So we want a current ratio. We want a current ratio of like current ratio should be 2 or more. That's very important because current ratio, it shows if the company can cover its short-term debts quickly. So that's what's very important about it. And then debt to equity ratio, debt to equity is debt divided by equity here. So we want to have it low is better. Decreasing is better. So we want to have it low and decreasing. And then net profit margin, we want net profit margin and ROE higher and increasing. And then price to earnings ratio, we want P/E, price to earnings ratio, 10, like around 10. Lower the better. So in this case, I'll ask you, does the current ratio, debt to equity, net profit margin, ROE, and price to earnings meet the standards we look for? So do all those here meet the standards we look for? And you can use you can use what we learned here to analyze companies on Google Finance and Yahoo Finance. Yeah, so Autry brought up a good point. Current ratio is not 2 or more. That's a good point. So they're barely covering the short-term debts. So yeah, good point, Autry. And then what about debt to equity? Is debt to equity meeting the standards we're looking for? Yeah, exactly. It's increasing, so that's a worry, that's a concern because they're taking on a lot more debt and they don't have the equity that they need to for that debt. And then what about net profit margin and return on equity? Yeah, it seems like in this, yeah, so it seems like the numbers are getting worse. Yeah, I agree that numbers don't meet the standards. Yeah. So it doesn't seem like Apple's a good investment based on this data, but this is 9 years ago, like 2014, 2012, 2014. That was a long time ago. So it might be different now, but back then, Apple doesn't seem like a good investment. So yeah, good point on that analysis, everyone. So you can use these questions. So you can use so when you're looking at companies, so when you're looking at when you are looking at investments, look at current ratio, debt/equity, net profit margin, ROE, and price/earnings ratio. So that's very important for investing. So the investment philosophy of Warren Buffett, the basic ideas of investing are to look at stocks as businesses, use market fluctuations to your advantage, and seek a margin of safety. That's what Benjamin Graham taught us. 100 years from now, they will still be the cornerstones of investing. So you want to, and then margin of safety is when you buy a stock for a fair price for when you buy a stock at a fair price or a discounted price. So I'll say buy a business. Buy a business for a fair price or a discounted price is what they say by margin of safety. So that's very important here. So yeah, ask these questions before you invest. So is the business simple and easy to understand? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is management rational? Is management candid with the shareholders? Does management resist the institutional imperative? Focus on return on equity and on earnings per share. Calculate shareholders' intrinsic value. Look for companies with high profit margins. Make sure the value added is greater than one. What is the intrinsic value of the business? Can the business be purchased at a discount to its market value? So those are good questions to ask. Is the business simple and understandable? Does the business have a consistent operating history? Does the company have a favorable long-term prospects? Is the business simple and understandable? Does the company have an identifiable, durable competitive advantage? Does the business have an identifiable consumer monopoly or franchise product? What is the chance that the product will become obsolete in the next 20 years? Is the business simple and understandable? What does that mean? Does the business make a product that's simple or complex for the average investor to understand? So one of the companies he invested in is See's Candy. So they can build candy all the time, and it doesn't really need new technology. So that and also it doesn't really change. Candy doesn't really change from year to year. But then we compare that to Intel. Technology is always changing. So the competitive advantage of Intel can be gone pretty quickly, while the competitive advantage of See's Candy can stay the same because of just because candy doesn't really change. So based on this, looking at this information here, specifically earnings per share here, book value per share, net profit here, shareholder equity, average return on equity, and 5-year average cash flow growth. Does the business have a consistent operating history? Does cash run this one? So I would say during this period it does. The book value per share has went from $4.42 in 2009 to $19.02 in 2014. So it's basically went up by 4 times in that period, more than 4 times, and the earnings per share have went up by from $0.90 to $6.45. That's a big increase. Net profit has increased from 5.7 billion to 39.5 billion during that period. Shareholder equity has increased from 27.8 billion to 111 billion. So there's been a big increase in operating history during this period for this company. So during this period, if you invested in 2009, you would have probably made a lot of money by 2014 because there was a huge jump in all those types of statistics here. So some mottos of Warren Buffett: an investor needs to do very few things right as long as he or she avoids big mistakes. We like stocks that generate high returns to invested capital, whereas there's a strong likelihood that will continue to do so. I look at long-term competitive advantages and whether that's something that is enduring. So management tenets Warren Buffett has: is management rational? Is management candid with its shareholders? Does management resist the institutional imperative? So when you have able managers of high character running businesses about which they're passionate, you can have a dozen or more reporting to you and still have time for an afternoon nap. In evaluating people, you look at 3 qualities: integrity, intelligence, and energy. If they don't have the first, the other will kill you. So what is integrity? What does integrity mean to you? So being honest is a good point. So question: I'm confused by consistent. Suppose the consistent trend is growth. Which primary metric says the growth is unsustainable? Yeah, that's a good point. It may not be sustainable. So that's something that you got to look at. If it's unsustainable, it wouldn't be consistent. So yeah, that's a good point. Cash is bringing that up. So yeah, make sure it's so if you think so, you want businesses that will constantly change and improve, because the problem is there's a lot of competition. So you want the business to continually to change their product and become better over time. So important questions to ask are: what is the return on equity? What are the company's owners' cash flows? What are the profit margins? Has the company created at least $1 of market value for every dollar retained, value added? Does the company have less than 30% debt? So so you can analyze this here. So I'd recommend analyzing this chart. I'll put it in the chat, and determining if Apple would be a good investment based on this data. So is Apple a good investment based on this data? So I'll ask you as a class right now: is Apple a good investment based on this data here? Yes, yeah, I agree. I agree. I agree. Yeah, so the earnings per share have been increasing. So the earnings per share have been increasing in this graph, in this chart here. So good point, everyone. So earnings per share have been increasing here. The annual P ratio has been going down. Book value per share is going up. Dividends per share have been going up. Cash flow per share has been going up. Net profit has been going up. Net profit margin has been steady. Return on equity has been going up. So as the return on equity going up is a big point that Warren Buffett looks at. Yeah, earning per share, net profit, no debt. Yeah, that's great. Debt has went up last 2 years. That's a good point. That might be a risk factor. Good job, Autry. Good job, him. Great job, Ashish. Excellent work. So good job on the analysis, everyone, on that one. So the Warren Buffett way, value tenants. What is the business value of the company? That is the intrinsic value. Can the shares be purchased at a significant discount, roughly 50% to its current trading price? So this is hard because usually these companies are fairly priced already. So that's very difficult. So I'd recommend just buy it at a fair price. So don't worry about buying at a discount if you can't. If you can buy it at a fair price, that's fine. So Warren Buffett's four principles of investing. Company must have capable and vigilant leaders. The company must have long-term prospects. Is the stock stable and understandable? The company must be undervalued so you can make a good buy. So you want low debt. Debt to equity ratio should be less than or equal to 0.5, and debt to total assets must be less than less than or equal to 0.3. High current ratio. Current ratio should be greater than 1.5. Strong and consistent ROE. Return on equity. Buffett requires 8% average over a 10-year period. Cole likes to see an average of 15%. Appropriate management incentives. So those are very important things that we gotta look at. So I will post it in chat here. So here, yeah, a lot of these return on equity is higher than the 8% because it's at 35.4% in 2014, 30% in 2013, 35.3% in 2012. It's higher than that 8%, which is good. But the debt to equity ratio is higher than Warren Buffett wants, because I think he wants about a 0.5. So it's higher than that. And the current ratio is not exactly 1.5. So those are big issues to this investment. So you want vigilant leaders. So you want to have able managers of high character running businesses, about which they're passionate. You can have a dozen or more reporting to you and still have time for an afternoon nap. In evaluating people, you look for three qualities: integrity, intelligence, energy. If you don't have the first, either will kill you. In the long run, of course, trouble weights management, the paper over operating, problems with accounting maneuvers.